My name is Michael Scott Forehand. Today is the 12th of October, 2023. It's just after 5:30 p.m. This is our bi-monthly Debt-Free Life Infinite Banking presentation. There's no real rules to this. We're going to start off with a normal 20 to 30-minute presentation about debt-free life and infinite banking. Then we've got our special guest, Derek Fitzgerald, who'll be we'll be interviewing and speaking with Derek. And then the last 20 or 30 minutes of today's presentation will be looking at some kind of advanced market concept about how these programs can work. As we go through this presentation, I've asked Derek to kind of give some color commentary. And also, I know that Derek does a tremendous amount of these programs, and he's probably got some insight that maybe I haven't come up with. And then I've already told him that whatever he says that I'm not using, I'm going to steal it from him. So here, just saying it out there and putting it on the record, I'm going to steal from Derek Fitzgerald tonight. Plus, we're all going to have the recording, so we can all steal from him. He doesn't know that. Shh, don't tell him. All right, so that's the idea here. We want to go ahead and basically, this is the symmetry process. We all learn from each other. We all teach each other, and hopefully, when you get an opportunity, you're helping teach, coach, and mentor other people. All right, so let's go ahead and get rolling. I'm going to share my screen. It's almost like I haven't done this in 2 weeks. Okay, so here's debt-free life. So what is debt-free life? Debt-free life is the proprietary infinite bank program that's offered by Symmetry Financial Group. Debt-free life is really focused on not just wealth accumulation and legacy creation in the form of the life insurance component and the cash building component, but it's also really focused on eliminating any kind of debts that someone may have. That could be a mortgage, a car, multiple cars, credit cards, student loans, back taxes, medical bills, personal loans, whatever, any kind of debt. Let's be clear about debt for a second, though. So a debt is something that you have a specific amount of money that you owe, that you can get to the end, and then you no longer owe it. A credit card is a debt. A power bill is not a debt. That's a bill because you're going to get another one next month. So what we're focused on here is eliminating debt, because in the end, if we're using these as retirement programs or potential retirement vehicles, our goal is to eliminate the number one detractor from you being able to have a comfortable retirement, which is a debt load. Because once we can eliminate the debt, you're able to save in a more efficient manner and significantly faster as well for your retirement, and make the money work for you so that you're no longer working for the money. All right, let's keep going. All right, so debt-free life. The primary two questions that we ask with the debt-free life program is, are you 100% sure you're going to be have a solid retirement? Or the other question is, if we could show you a way to get out of debt, this says 9 years or less, I'm going to tell you the actual numbers that I've done that I look at, it's 15 to 27 years early. So if you have someone with a 30-year mortgage, for example, the worst case scenario of this program, worst case, it's going to cut it in half. It's going to cut it down to 15 years. That's the worst case. And the interesting thing about these programs, and I'll show you why later, but the interesting thing about these programs is the more debt you have, not the amount of debt, not the 100,000 versus 300,000, but the number of debts. The more debts you have, the faster the program works. And it doesn't make a lot of sense, but mathematically it does. And we'll show you that's part of this process. That's why this is really a really cool tool to eliminate debt and grow wealth. Right. If you were like most Americans, this is what your pay looks like. And this is absolutely not what the founding fathers of our country had in mind. You're making 100% of the money that you make, but only 23% of it are you actually using for life, to live life, to hang out with your family, to pay your power bill, gas bill, light bill, whatever. Most of the money that you make is spent on debt service in the form of interest or taxes, which is just another kind of debt. And this is why did the Tea Party happen, right? This is why, right? And then finally, when people are saving for retirement, that becomes pretty glaring as you get closer to that retirement age about how short you're going to be. So when we do an income gap analysis on a client, and we say, how much are you making now? $100,000 a year. How much are you going to be making when you retire from Social Security? If Social Security is around, which they've already telegraphed that in 2034, it's going to lose 22% of the payouts. How much you gonna be making then? 60,000. So you've been making $100,000 a year and you're gonna lose 40% when you retire. How long is it gonna last? And then what the reason why I'm putting it that way is because that 3% sliver that you see at the top of this little pie chart here, that's what people are actually saving for retirement. That's the norm. The norm is that people save 3% of their income. And the problem with that is it's not enough money. And unless you have a plan to completely eliminate all of your debt before you're retired and get rid of that debt load and get that debt monkey off your back, it's going to be very, very tight. And unfortunately, you're probably going to be returning to college and you're going to go back and you're going to start eating tuna fish and ramen for dinner because that's what's cheap. And it shouldn't be that way. And it doesn't have to be that way. And that's why these programs, I love these programs because they can get you to a point where they aren't that way. All right, let's keep going. And Derek, feel free to unmute and jump in anytime you got something you want to add because you're the wild card here, brother.
Yeah, no, man, you keep going. You're good.
Okay.
I'll let you know when you say something wrong.
Oh, thank you. Thank you for that. I appreciate that. And George, you too. If I mess something up, George, please correct me. Okay. And do it sternly, George. All right. All right. So here we go. The average American makes $2 million in their lifetime. And that is a lot of money. And it's plenty of money if you save it right. And most Americans don't. And that's that 3% number that we're looking at. 3% is $60,000, which means the average American, after making $2 million in their lifetime, has saved only $60,000 for retirement. And we are becoming more and more dependent on the federal government, Social Security, right? If you talk to anybody who's an old school retirement person, they're going to tell you everybody's retirement is like a three-legged stool. You've got the money that you save on your own. You've got your retirement income streams and pension from your employer, and then you've got Social Security. You got a three-legged stool. Well, what's happened in the last 10 years or 15 years or 20 years? That pension has gone away. So now you have a two-legged stool. Two-legged stools don't stand up well. That's the problem. So what we're trying to do here is we're trying to rebuild that missing leg, which we're going to do it in the form of the most powerful conservative investment strategy on the planet, which is an infinite bank. Right? So let's keep going. This is where most Americans are. And if they get to the point where they've got enough debt where they feel like, oh no, I'm never going to pay this off, like especially, oh my God, student loans are evil if you let them build up. There's a strategy to eliminate them early in a program, and that's probably what people should do. But right now, most people are realizing almost too late that they're not going to have enough money for retirement. They're going to have too much debt. I have a gentleman I'm working with right now. He's going to retire next year. His retirement plan, he's going to lose his $80,000 a year job. That was his plan. And he's going to have $80,000 less income, but his expenses aren't changing. So we fixed it for him. But the point is, if you don't think about it soon enough, it can become almost too difficult to fix. And then all of a sudden, and you've seen it, you go to Walmart and there's an older gentleman or an older woman standing at the door on the checkout, checking your receipts, right? Or they're greeting you when you walk in. Not that there's anything wrong with Walmart, but these people are not going to Walmart to work as a greeter or as a receipt checker because they want to. They're going because they have to. And that's the problem. And when we get older and we've worked our entire lives, we shouldn't have to do that. And it requires a little bit of planning. And really, one of these programs should be part of that. All right, let's keep going. So our way, in my opinion, is a much better way. We can eliminate your debt faster than you ever thought possible, 15 to 27 years early. We can leave you with what will become a tax-free, not tax-deferred, tax-exempt or tax-free retirement program. And then the IRS can go pound sand when they want you to pay tax on your incomes. You're not going to take it in a manner that's considered income. This is a better way. And if you listen, Ted Brenna, at this point, about a year ago, it was October of last year, he did an interview with Bloomberg. Ted Brenna, the guy from Johnson & Johnson that did the very first 401k back in the 1970s, the godfather of the 401k. And they asked him, should people be how much money should people be putting into 401ks? And his response was nothing. You shouldn't be putting money into a 401k. It has become, there's too much governmental oversight, too much government regulation, too much taxes. They're not being used the way I designed them. And you should be in what's called a 501k. Okay. Now, if you look at the tax code, there's no such thing as a 501k as it pertains to retirement programs. But what he was speaking of, and he went on in that interview to explain, he's speaking in specifically in terms of a program where you can grow capital, grow cash in a non-taxable manner without the restrictions that an IRA would have on it. So even a Roth, you can grow it in a tax exempt manner, but you have restrictions about when you can touch the money in a Roth. There's also restrictions about how much you can put into in a Roth. And oh, by the way, you can't spend the money in the Roth more than one time. Remember that. We're going to talk about that in just a minute. All right. So there's a better way. This is the better way. We want to move you from the left side of your screen to the right side of your screen. We want to make it so that you're not spending 23% of your income on your fun, on life. We want to increase that to 33%. We want to decrease the amount of money you're paying in taxes over time from 40% down to 30%. We want to decrease the amount of interest you're spending, and we want to increase the amount you're saving for retirement. And understand what I just said. I never said, and we want you to earn more money. It's not the case here. And I'm not telling you that right now you don't need to go out and eat tuna fish and ramen. Now, for the record, I ate ramen earlier today, not because I had to, but because I love it and it's really bad for me. That's why I ate it, because bad stuff is the stuff I like, which is why I look the way that I do. Okay. So the point here is that we want to have choices. We want to have options. We don't want to be forced into doing something. And in this particular instance, this is about how you spend money and save money. That's all this is. And we're going to show you a better way to spend money and save money using an infinite bank. And we're going to get you from the left side of your screen to the right side of your screen. Let's put this, I like using numbers and I like the math. Here's the math. 3% savings versus 15% for retirement, right? What does that really mean? That means we're increasing the amount of money you're saving for retirement by 500%. That's how that number works, right? So if you make $60,000 a year and you've saved only $60,000 over the course of your 55 or 65-year life, how long is that money going to last? Not long. Okay. But if you've got $300,000, which is 500%, and you've got, even though you don't have a pension, but maybe you've got Social Security, it'll go a lot longer than 1 year. And that's the idea, folks. We want to give you time, give you freedom, and give you options. Right? Let's keep going. Derek, I'm expecting you to jump in anytime, man.
You keep going. You're doing fine, Scott.
Thank you. Thank you, Mr. Fitzgerald. Okay. All right. So how are we gonna do that? Right. So you see the bullet points on your screen, right? It's not rocket science. I know that if I can reduce the amount you're paying in interest without having you make any more money, then that's extra cash you've got left over. I know that if I can reduce the amount you pay in taxes without making any more money, then you're going to have extra money left over. What do we do with that money? Some of it goes to your retirement. Some of it goes to your lifestyle. Now, all of a sudden, you can afford to take that family vacation that you've taken one every 5 years. Now you can take it every year. Now you don't have to go to the restaurant and look for the cheapest thing on the menu. You order whatever you want. Now you can walk into the grocery store and you don't have to worry about trying to buy the meat that's on sale because it's a week and a half old. You can buy whatever you want. You don't have to look for just the manager's specials. And I'm saying all those things because I was that guy. I did all that stuff. Okay. And it doesn't have to be that way. And then that last bullet there, allow you to retire with a tax favored income. Mr. Fitzgerald, I have a question for you.
Yes, sir, Scott.
If you had different kinds of tax favored incomes for retirement, what would be the best kind of tax favored income?
The kind where I don't have to pay taxes.
Yay! A tax exempt. That is the most tax favored of all kinds of tax favored incomes. The one you don't ever have to pay taxes on, right? That's where we go with this. And I saw you pop in here, Sue J, so I know you're listening. So that's good. Take notes. There's going to be a quiz tomorrow in our appointment. All right. So here's the 80-20 rule, right? The 80-20 rule is simply this. There are other kinds of programs that are out there on the market that do the same thing that we do. There's 5 that I can find. They all are different riffs on different methodologies. One, it's called the Australian model. It's really good for quickly eliminating short-term debt like credit cards. It's really bad for everything else. Not to mention, it's also essentially a variable rate loan that you don't have any control over, that the person or entity that gives you that loan can call it due anytime. So if you run into somebody who's trying to market an infinite bank concept to you, and you hear the words home equity line of credit, run away. It's a huge, huge mistake. I have one of my clients right now who listened to that person 4 years ago, got in on a home equity line of credit 4 years ago, canceled her mortgage and put it all into a HELOC 4 years ago. Anybody remember what's happened in the market 4 years ago? It was great, right? She got her loan at 2.2%. Fantastic. She's been paying interest only for 4 years. This year, the first year it's going to adjust. Guess what? It did adjust. It adjusted at the maximum rate possible. Guess what her loan interest is now? 7.2%. And now, even though she could have been paying principal, she wasn't. And now she's in a situation where she can almost not afford the 7.2% interest rate that's interest only. And guess what? She's got 6 years before there's a balloon and the whole thing's due, unless they want to call the note sooner. So the lesson here is, if someone's trying to market one of these programs to you with a home equity line of credit in the current economic environment that we're in right now, headed for a recession or depression, stock market's getting ready to tank, mark my words, don't do it. No HELOCs, no HELOCs. Option number 2, I've only had one client that actually recommended this to in the last 5 years. This is called a sweeps campaign. And what that means is they take a piece of software that's very expensive that goes into all of your bank accounts at one time at 11:59 p.m., moves all the money from all those bank accounts in one time to a high interest earning savings account until 12:01 a.m. And then at 12:01 a.m., it moves it all back. That software costs about $50,000. And unless you're moving $100,000 at a time, it takes about 7 years moving it back and forth, doing that process, capturing that for that 2-minute period, capturing that high interest rate. Takes about 7 years for that to become profitable. For the first 7 years, all you're doing is paying off the cost of that if you're trading only $100,000 at a time. So most people, not a good solution. All right, the other 3 types of programs, and this is why we're still looking at this slide, the 80-20 rule. The other 3 types of programs, one is built on an IUL, an indexed universal life. One is built on a standard whole life, which was the original one done back in 1904 by John Rockefeller. And one is done on a participating whole life, which is what Nelson Nash wrote his book on, called The Infinite Banking Concept, back in the 1960s. Okay. The one that we do here is the one that's based on Nelson Nash's book and the participating whole life, the infinite bank. Okay. The problem with Rockefeller's version is, why did he do it? He did not do it for debt elimination and cash growth. He did it for generational wealth creation, because all he did was put money in there, let it sit, take loans from it, and then dump it into other programs that were for his great grandkids and his grandkids. So they would have 60 years of compounding interest and make that $50,000 turn into 20 million. That's how the Rockefeller family, this is one of the ways the Rockefeller family made a lot of their money. The other option, the IUL, I like IULs. They're good for a purpose. The problem with using this with an IUL is, no matter what plan you make, no matter what schedule you set up, you don't know. Because you don't know whether that IUL is going to perform this year, next year, or the year after that. So you can't make real plans. And if you've got this debt that's slowly growing because you've got this interest rate, this high interest rate, then you don't know whether or not you're going to be able to make that first big payment in year 4 or year 5 or year 6. And you don't have a real plan. You have a hope. And a hope is absolutely not anything that you should have in a financial plan. Hope means nothing. So get that out of the way. Don't be hoping you're going to have enough money. Know you're going to have enough money. And that's why I like this program. So Why did I say all that for this? The 80-20 rule, because all those other programs fail for a reason. And most of the time, the reason is you didn't plan for an emergency. You didn't have proof or a guarantee that the interest rate was going to be stable. You didn't have proof or a guarantee that the return was going to be stable. They're all the same thing. So what about us? Well, with us, we plan for the emergency. With our programs, there's about a 20% additional amount of money that's hidden, that you can't get to it unless it's a real emergency. And I don't mean I need to go buy a new jet ski emergency. I mean a real emergency. My brother and my sister-in-law just lost their jobs. Their house is going to get foreclosed on in 2 months unless somebody can give them $40,000 to rescue their mortgage and get them to the point where they can refinance it. That's what I mean, a real emergency. Okay. And there's an emergency fund here. You can get to it, but it's hidden because you can only do it one time. And that means it's a real emergency. And if you do it that one time, the game's over because you're actually canceling your program. All right. So how does this compare to other types of retirement programs? Well, so the 3 types of standard retirement programs we're going to find out there are ones that are taxed, ones that are tax deferred, and ones that are tax exempt. So what's a taxed program look like? A taxed program looks something like you've got a couple of accounts, maybe you got a money market account or something like that with your bank, and you're putting money in there and it's growing. And it's growing slowly, but it is growing. That's a taxed account because the money that you put in there and the money that you make, both of them are taxed. What about a tax deferred? Well, that's your 401k, 403b, 457, KIOSEP, FERS, TSP. They're all the same thing. They're all types of IRAs. You're going to put money in now. You're not going to pay tax on it because someone lied to you and told you that when you take it out later in life, you won't pay as much tax. Has anybody seen the tax rate go down in their lifetime? Anybody? No. Has anybody noticed that our country is $33 trillion in debt and growing? Yep. So what's the federal government's only way out? Actually, there's 2 ways. They can stop spending money. Ever seen a politician try to stop spending money? That's not going to happen. Or they can increase taxes. That is their only way out of this debacle. And if you've been paying attention recently, the BRICS countries just dumped like, I think, 10 or 12 trillion dollars of US bonds, which is tanking our bonds right now. The point is, they're going to have to stop spending money or increase taxes. They're not going to stop spending money. They're going to increase taxes. Excuse me. Derek, say something for a second.
Yeah, absolutely. So that's one of the things that I've picked up. I'm sure a lot of people I've seen in the advanced market calls. It's always a question of, do we think that taxes are going to go up in the future, or are they going to go down? I mean, Scott has a very eloquent and thorough way of putting it here, but it's common sense. And I'm now talking to 7 people a day. Of the 7 people a day I'm talking to, and I ask that question, I don't think I found one person who goes, yeah, you know what? I think that taxes are going to go down. So it's something that is, as we're talking to folks, as we're educating folks in this process, it's just common knowledge, it's common sense, and to do anything different would be foolish.
Right. Agreed. Well put, Derek.
I'd like to add to that, man. The shell game that they're playing with us is that, yes, you're going to be in a lower tax bracket.
Yeah.
But it's highly likely that the tax increases will outpace that.
Right.
So it's a shell game.
Right. So the middle income tax bracket 10 years ago was 6% less than the middle income tax bracket this year. Okay. So if it follows that track, then we're looking at 10 years from now, the middle income tax bracket will be 6% higher, okay, than what it is right now. So right now it's at 28. So the middle income tax bracket should be in the mid 30s in 10 years, which means, yeah, you might be in a lower tax bracket, just what George just said, but you are not going to pay less taxes. And the federal government knows that. That's why they continue to try to push people and tout how good a 401k program is, or a 403b or a 457, because it's tax deferred. It is tax deferred. It is not reduced taxes. So what you're actually doing is you're growing income for the federal government, and that's what they're banking on. One more thing, there is a really disturbing bill that was actually put out 2 years ago on Capitol Hill. It didn't go anywhere, but the fact that they were thinking about it scares the hell out of me, which was the bill was they were going to start looking at the sizes of people's retirement programs and look at their current income level. And if they felt like your income program was going to be close enough to maintain your current level of living, they were going to start taxing your income, your retirement program, while it was still a retirement program, and start taking money out of it. So that scared the hell out of me, which is why these programs, what we're talking about right now, these IBC programs, are so incredibly powerful, because it's not subject to government regulation through the IRS. It's subject to regulation through not through banking code, but through contract code. And so therefore, in order for the IRS or anybody else to come after the money that's in these programs, they have to be able to attach a lien or process a successful tort or lawsuit against both parties at the same time for the same reason. And since your insurance company here that holds this money is not doing the same things you do, there's never going to be an instance where they're going to be able to sue you or assign a lien for the same reason or the same infraction at the same time. So therefore, there's nothing that will ever be successful, because this is written under contract law. And all contracts in contract law are subject to contract law at the time the contract is struck. So if you do this today and they change the contract law tomorrow that says, yeah, we can take all the money in your life insurance policy, guess what? Doesn't matter, because the contract was struck today. You're grandfathered in on the law today. All right. So anyway, I digress. Thanks, guys, for taking over while I have my coughing fit. Derek, you're still unmuted. You got something else you want to add to that?
No, you go right ahead.
All right. So this is what it looks like if you do 3 different types of investment: tax deferred, tax exempt, or taxed. The numbers don't lie. Math doesn't lie. That's why I love math as a language, because there's no getting around it. It is real. And this is the way. If you take the same $10,000 investment, invest it for the same 28 years using a same average interest rate. Good luck finding something that pays a 7% interest rate, by the way. And then staying at a 25% tax rate, which, good luck again, it's going to be higher. This is the result you can see. And the reason why you see that tax-free one so much higher is because you paid the tax on it before you put the money in there. This is in our terms, in financial terms, this is called a non-qualified account, meaning it does not qualify for tax deferment. So we paid tax on the money before it went in there. Let's keep rolling. All right. This is a financial instrument, a financial tool. All financial tools work in phases: maximization, accumulation, distribution. What is the maximization phase? The maximization phase of any financial instrument is getting you to the point where you have maximal growth in that financial tool. It could be, as is the case for people that have a debt load, it could be that all we're trying to do is eliminate the debt load so we can start saving more for retirement. It could be that I've got, I know I'm getting a big raise next year and that's it before I retire. So that would be your maximization phase. There's lots of different things that make up a maximization phase, but that's all that means. It just means we're getting to the highest and best number that we're going to save for retirement. Accumulation. This is after we have completed the maximization phase. We are now at our highest and best number. And I'm going to be chunking money into the program or programs for as long as I can until I retire. And that's when I entered the distribution phase. Now I'm taking money out and I'm using it as support, income support, or play money, or whatever I want to do with it. It's my money. Okay. So the idea here with the way we build these programs, we want to get you out of the maximization phase as quickly as possible, which means if you have debt, student loans, car loans, credit cards, back taxes, medical bills, mortgages, second mortgages, HELOCs, if you've got debt, we want to eliminate it as quickly as possible so we can get you into that maximization phase. All right. That's all this slide is supposed to show you. I mentioned Rockefeller earlier. These programs are not new, folks. They've been around for a very long time, but you should see the people on your screen. These aren't just, run-of-the-mill people working a 9-to-5 job. These are very wealthy people. And the reason why wealthy people know about this program is because this is a kind of a common strategy with wealth management. And a couple of years ago, it became more and more popular, or more and more available to people that were not of the financial capacity of the people that are on your screen. But all these people used infinite banks for something. So, for example, Walt Disney used it to fund Walt Disney World. Doris Christopher used it to fund building Pampered Chef. Ray Kroc used it to fund the first 11 McDonald's units. And when I say that, let me put that in perspective. All that means is that he duplicated the funds over and over and over again. He put the money in, let it sit there, took a loan against it, built the next McDonald's. Let it sit there, took the money out, built the next McDonald's. Just over and over and over. In real estate, this is called daisy chaining. It's the same thing. Where you're just using a life insurance vehicle that has guaranteed cash growth plus a dividend that's going to be replenishing itself over time, plus I'm paying into it. There you go. All right. Oh, yeah. Some guy named Warren Buffett. The last time I looked, he has 14 of these running right this minute. 14 folks. Think Warren Buffett might know a little something about finance? I think maybe. Okay. So why life insurance? There's a couple of reasons. Number one, tax code 7702A, which says something very specific, and it is this: all money derived from a life insurance policy is tax exempt. That's it. So if I'm taking money out of a life insurance policy, it is tax exempt. Now, there are certain circumstances where that won't be the case, specifically if it becomes a modified endowment contract. If I take the money, if I take too much money at a certain age, if I take all the money out of a program and then cancel it before 59 and a half, then yes, I will owe tax. So there's some of those more esoteric things that happen. But as long as you're planning on using this and it's a long-term solution, you're not going to have tax. And then all these other bullets that you see here are other reasons why we're using life insurance. Every one of them is relevant. Some of them are more relevant than others to you. And every person's different. And that's one other thing. There is no cookie cutter approach to the creation of these programs. It is always going to be based on your current circumstances. No two people make the same amount of money, have the same amount of debt, or have the same retirement aspirations. No two people are the same. And those three factors are things that really help us shape these programs when we create these for clients. All right. This is 5 years old. Wow. This is 5 years ago. These were the first group of families that we actually helped with these programs. And that was the amount of money that we've saved for them. My record is about $1.8 million for one family. My record for businesses is somewhere around 2.5 million. No, 25 million. Sorry, $25 million. So how these programs are structured can really depends on the individual's needs, but also there's a program. I mentioned tax code 7702A. There's another tax code, actually two more. Tax code 101J has a bearing on how these programs can work, and also tax code 162 has a bearing on how these programs can work specifically for businesses. And there's a way within 162 you can actually make these programs not only tax exempt when you pull the money out, but you can actually tax exempt the money when you put it in too, using tax code 162, which is pretty slick. All right, let's take a look at how money flows. So first off, everybody is this way. Okay, this isn't just you, this is everybody. And the reason why we are what I'm getting ready to show you is because we are taught how to spend and save money by the banking industry. It is in their best interest that we do things the way that we're doing them right now. Okay, so what does that mean? Looks like this. So you make your money. 1099, W-2, W-4, doesn't matter. However you make money. That money gets deposited into your checking account. While it's in your checking account, your bank is lending that money out every night at the federal funds rate or higher. The magic number is 61 cents. The average dollar that you put into your bank account makes your bank 61 cents before your bank allows you to use your money. And I use that word allows on purpose because in the end, have you ever noticed that you don't get immediate access to your money when you put it in there? Have you ever noticed there's always some reserve? Have you ever noticed that when you try to take money out, especially large chunks, it's never transmitted immediately? Right. The reason why they do that is because the longer their money is on their books, the longer they get to spend it or lend it, actually, is what they're doing, lend it out and make money with your money. That's why the average dollar in your account is going to be there for at least 7 days, and it's going to earn your bank about 61 cents. Okay. So your bank is making money with your money, and you are taught how to spend and save money by the banks. And why? So they can make money. So while the bank is making 61 cents with your dollar, Derek, how much money are you making with your dollar?
Pretty much, I mean, I think the FDIC came out with a report saying that it was 0.42% interest,
Maybe.
maybe on average.
Yeah. So most people actually zero. Most people with checking accounts, unless you've got larger volumes of cash in your checking account, most of the return is zero on a checking account. So they're making money with your money and paying you nothing, right? Banks can't, this is the primary methodology of how banks make money, right? It's not the fact that they're lending you or giving you a credit card at 24% interest. It's the fact that they can borrow all the money in your account every night and make money with it without paying you anything. In the end, what happens is you stroke a check or you go into your bill pay and you tell your bank to pay your debt, which then what happens is your money becomes your creditor's money. And Derek, if you're really, really nice, and I know you and you're a really nice guy, and if you really turn the charm on and you call that car company that you just sent the check to and say, you know what, I want to thank you for giving me the loan. And I'm glad that I was just able to pay you that $550 payment, but I really kind of need the money right now. Will you give me the money back? What's going to happen there, Derek?
I've yet to find the lender who will allow me to take my money back.
Right. Nobody will. Once your money becomes their money, it's now their money forever and you're not getting it back. So that means in this example, Derek, let's follow this bouncing ball for a second. So you have money in your bank account. Okay. And then your bank made money with your money. And then you transferred your money to a debt. What it was here earning money for your bank, and now it's here earning money for nobody other than your creditor. What's your gain in that scenario? What did you gain?
Absolutely nothing.
Nothing. All you did was change the status of your cash from cash in your account, cash flow, to equity in some kind of widget, car, house, reduced debt. It's a one-for-one transaction. You have zero gain. And here's where our program makes all the difference. Same way you make money, same place, income gets deposited into your checking account, right? Aha. But now it changes. Why? Because we make a payment to our private bank life insurance program. So we take the money off the table. The money goes up, one check gets deposited to our creditor or our carrier, our life insurance company, and it gets split into 3 parts. It gets split into term, whole life, and paid up additions. Now, the majority of the money you do send this way is going to be put into paid up additions. What's important about paid up additions? Paid up additions, what it really stands for is paid up additional life insurance. Paid up additional life insurance. So Derek, if I have a life insurance policy that I just paid $1,000 for, and it gives me at least $1,000 worth of death benefit, how much is that death benefit going to be worth tomorrow?
$1,000.
Did I have to spend any money to maintain its value?
No, you did not.
No. How much is it going to be worth a year from now?
$1,000.
Did I have to spend any money to maintain its value?
Nope.
How much is it going to be worth when I die?
We've got a death benefit.
Right. So it's $1,000, right? I paid for $1,000 life insurance. It's still worth $1,000, right?
Mhm.
Did I ever have to spend any money to maintain its value?
No.
No. What I just explained to you, or what Derek just helped me with, this is what's called in the banking industry a tier one asset. It is a permanent value thing. Gold has permanent value. Derek, how much is gold going to be worth tomorrow?
Whatever the price of gold is.
Right. And then the day after that, how much is it going to be worth then?
Depends on the price of gold on that day.
Can you tell me with 100% accuracy whether it's going to be worth more or less than what it's worth today?
I cannot.
You cannot. So what most people think of as a very secure asset, gold, precious metals, silver, it's not, because you have no idea what the value of that thing is going to be in the future. So that's why when you look at all these companies that are out there, especially banks, but it's not just banks, GM, Heinz, Boeing, pretty much every large bank, Wells Fargo, Bank of America, PNC Bank, all these companies buy life insurance policies that are paid up. I heard an advertisement today from Coventry Direct that said, hey, if you've got $100,000 of life insurance, don't cancel the policy. Give us a call first. It's probably worth some money and we'll pay you for it. And you'll never make another premium payment. Anybody ever heard of JG Wentworth? Right? So the point is that banks know this has value because what Derek said just a minute ago, 100% value on day one as soon as you make that payment, and the value of the program never dies. The face value of the policy never drops, and I'm spending zero to maintain it. The majority of the money that you spend for your program is going into that third piece, the paid up additions, right? So the majority of the money you pay for this program is going into cash growth. Now, here's the cool thing. The IRS sees that as life insurance. The carrier sees that as you giving them money that they're going to invest and make money with. And because this is a participating whole life, that means the carrier is going to pay me a fee to use my money. So this is a place where I'm going to get growth in my program without me having to spend money to get growth. So even though Derek and I, we just established that $1,000 life insurance policy today is worth $1,000 tomorrow, it's not. It actually grows. It grows at a rate of 3%. And if my cash value of my program is directly linked to the amount of paid up additional life insurance that I have, then what else is happening? The cash value is growing as well. So what does that mean? I took the money, rather than leaving that $1,000, we'll use that nice round number because I like nice round numbers, rather than using that $1,000 in my bank, where my bank can lend it out and make $610 with my $1,000, I'm going to say, wait a minute. I want to move it into my private bank, which I'm actually just going to pay my life insurance premium, the majority of which is going to go to cash growth. And now all of a sudden, my money is in my private bank. My private bank is making money for me every day for the rest of my life until I die. Okay, so now I've moved that $1,000 from my regular bank account, Wells Fargo, Bank of America, whoever, it doesn't matter, and I've moved it into my private bank. I've got a core whole life policy. Remember, I only make one check. It's one check that gets split into three ways. Some of it goes to whole life. An even smaller amount goes to term. The majority goes to paid up additions, which is cash growth. In that whole life piece, though, this is a whole life policy. One of the neat things about whole life is that it grows a cash value also. So I've got money over here in paid up additions, and I've got a little bit of money over here in that whole life piece. Remember that slide earlier where I said 20% is there and it's hidden? Ding, ding. That's where it's at. It's hiding in your whole life cash value, not in the PUA, in the whole life cash value. So if I want to get to that, I have to cancel the policy. That's why it's an emergency fund. Okay. So now all of a sudden, now I'm making money with my money, and it's compounding depending on which company we use. Some companies compound it annually. Some companies compound it monthly. And if you have two companies side by side and they both say, yep, we're going to guarantee you 3% compounded monthly, or we're going to guarantee you 4% compounded annually, guess which one's bigger? 3% monthly is bigger. Okay. So don't be fooled by the shiny, the bigger number. It's not always bigger. All right. Now, Derek, I'm still at that situation where I need to make my car payment, or I need to pay off my car. Right. So what do I do?
Yeah. Well, if I had an infinite bank with a debt-free life program, I would take money out of my savings account on steroids, my infinite bank.
Do I take a loan?
I take a loan.
I did not take my $1,000. So in this example, we're going to make George Matthews the bank. George Matthews is my bank. And I put my $1,000 into George Matthews Bank. And then I say, George, I want to actually spend my money, but I want to go ahead and send it up to Derek Fitzgerald, which is my infinite bank. So I gave the money to Derek. And Derek gave me the death benefit, and he gave me the cash growth and all that stuff. And all of a sudden, you know what, Derek? I need to pay my car loan. I need that $1,000 back. And what does Derek say?
If I'm your infinite bank?
Yeah.
Yeah, sure. Take the loan.
There you go. So notice what he just said, take the loan. So Derek's not giving me my $1,000 back. My $1,000 is acting as collateral. I'm taking a $1,000 loan against that $1,000. Okay. So the money gets put back into my account, and George is excited because now he sees $1,000 he's going to be able to make money with again, right? But then no, I tell George, I want you to go ahead and pay my debt, and I want you to send that money there. So that money becomes the creditor's money. Derek, where's my money?
Your money is in your infinite bank, and wherever you're paying that payment to.
Okay. So what just happened? What's my net wealth now? Remember in the previous example, I had $500 here and then $500 here, and this is gone, and all I'm left is the $500 of reduced debt. So what's my gain? 0 in that example. What's my gain here?
You've doubled.
I've doubled. That's why wealthy people do this program. Because every time you do this, every time you pay a debt, especially if you're paying a debt with somebody else's money, you're increasing your net wealth. So the biggest problem that people have with this part of this conceptually is, okay, but I still have a loan. Yes, you do. Don't I have to pay the loan back? Yes, you do. When will I pay the loan back? I don't know. When do you want to pay the loan back? Right? So you're getting a compounded interest coming in every month. The companies that we use are mutual companies, so they pay a dividend every year. You're making payments on the program anyway. Remember, you're sending your money for your life insurance payment. That life insurance payment is either paying down the loan, which is giving you more loan capacity if we're in that maximization phase where we're eliminating debt, or you're increasing the cash value, which is, again, giving you loan capacity so we can continue increasing, paying off your debt. It doesn't matter which way you go. Actually, it does, but so one way is slightly mathematically better than the other, depending on the stage you are. Okay. But in the end, that's all we're doing. That's called dollar cycling, folks. Now, all that means is we have this bank, this private bank that we own and we control, the bank of Derek. And Derek says, you know, Scott, this is your money. You can do whatever you want to do with it. I say, well, Derek, I want to take a loan. I want to pay off my car. Okay, take the loan. This is my cash. It's still here. Now I have a loan. Okay. This is how much I can continue to borrow. I've encumbered my bank capacity. And then next month I make another premium payment. Next month I make another premium payment. Next month I make another premium payment. Or next month I make another premium payment. Next month I make another premium payment. Next month I make another premium payment. Either way, I'm able to borrow more money again. Take another loan, pay off the next debt. But here's the kicker. Kicker is every time I pay off one of these debts, this is the second tenet of our program. We're using what's called a debt snowball. And please don't listen to Dave Ramsey. What he's talking about is not a debt snowball. That's called a debt stack, and he is wrong. Okay. If you do the math, what he teaches is not as efficient as a true debt snowball. And that's why we use a true debt snowball. There's only one. Just to give you an example, if you have 9 debts, there's over 520,000 different combinations you can use, different orders to pay off those 9 debts. Only one of them is going to be the best. And that one is the debt snowball. Okay. So don't buy into Dave Ramsey's debt stack stuff that he calls a debt snowball. It's not a debt snowball. All right. So in this example, this is how I'm creating wealth. And I'm almost done here, folks. I guess we'll do this. So this is a client that I just met with. About 4 months ago. This is their debt load. They had a lot of debt when I first met with them. In the grand scheme of things today, I see people with a lot more debt than this, but they had $585,000 of the debt. Their debt schedule, because there was a student loan in here, was going to be 40 years. They had 2 houses. It was going to take them 40 years in their current schedule to get out of debt. This was their real debt. You cannot consider debt where you've got loans as just the principal amount that you owe. The scheduled interest is a killer. And in this case, that scheduled interest was almost $200,000. So they thought they had $585,000 of the debt. That's not true. They were at $767,000. So our scenario, and this is meant to wow you, so it's going to, we went from 40 years to 7.8 years. These folks are now 4 years into this program. They are going to be debt-free. Actually, it's not 3.8 years because they're actually accelerated. They actually saw how well the program was working. And they started throwing extra money at it. So they're actually going to be out of debt in just under 2 years now. Okay. But we paid off 2 houses, $90,000 in student loans, a bunch of back taxes, credit cards, other personal loans, 2 cars, some other personal line loans, all that. It was going to end up being about 5.7 years. And that's the power of these programs. This is not magic, folks. This is just math. All right. One thing I want to show you here, though, is this. This program called for in month 53, they were going to pay off the student loan. In month 71, they were going to pay off their final property, which was an investment property. The distance in time in that right there is 18 months. This software that we use cannot think that I'm going to throw extra money at it, and it cannot think that I'm going to pay more, that I'm going to pay anything other than the total amount that I have to pay it off in one shot. Software can't do that. If you do that, though, if you actually take some money every month and throw a little bit extra at the debt every month, you eliminate the downline interest much faster and eliminate the debt in total faster. So anytime, that's called chunking. Okay, the technical term is chunking. So anytime you're doing a chunking routine on any kind of debt elimination strategy, the distance in time between the previous debt, in this case 34 months to 53 months or 53 to 71, the distance in time gets reduced by an average of 16%. So even though this program is incredibly powerful and it runs well and it's doing exactly what we told them it was going to do, the fact that they've thrown some extra money in and they're actually practicing chunking like I taught them on their mortgage, they're actually going to be out of debt in 5.7 years, 2.1 years faster. Okay. All right. So, oh yeah, by the way, this family, the gentleman was 35 when we did this program. He told me he wanted to retire at 55. That's pretty good, right? Not bad. Actually, he said he wanted to retire at 75. At 75 years old, he was going to have all of his debt paid off. Not bad. And $4.8 million liquid cash. That's pretty damn good, right? But when we ran this program for him, we said, you know what? You don't have to wait till then. You can retire at 55. You can retire at 55 with $1.5 million in the bank account. And what does that $1.5 million earn per year in this program? Because of the compounding and all that other stuff that's happening, it's earning 136,000 minus 21 minus 32. So this is earning about $104,000 a year. Do you think you could live on $104,000 a year tax exempt income? Not tax deferred, tax exempt, right? So that's the equivalent of about $170,000 a year income. That is the power of these programs, people. It's the debt elimination piece. It's the wealth growth piece. It's the dollar duplication piece. It's the fact that I can take my money anytime I want. If he had done that with a 401k, what would happen to him if he tried to take his money at age 55? Oh yeah, get out the checkbook. Uncle Sam wants their piece, and they're going to want it as a penalty because you're taking it too soon. What happens if he says, you know what, I've got my business running and I don't need the money? The IRS says, we don't care if you need the money, you have to take it. That's called a required mandatory distribution. You're going to take your money. And if you don't take it, we're going to tax you and give you a 50% penalty on what you should have paid on top of that. Right? So in this one, IRS cannot tell you when to take it. They can't penalize it if you take it too soon or take it too late, because this is not governed by banking law. This is governed by contract law. All right. There's the end of that presentation. Mr. Fitzgerald, what did I miss?
I don't think you missed much, Scott, but let me ask you this. When we're talking about, Tammy just had a good question. How much does the client have to put in? When you're structuring, are you structuring based upon the amount that they're making in overpayments? Are you structuring based upon their discretionary income? What is the best method?
All right, there's no one size fits all, and every two people are different. I can tell you there are 5 primary places where you can find money. The first one is what's their debt service right now? What are they paying money on? And what's the minimum payment? And how much are they overpaying? So that's the number one primary place that we find money. Number 2, how much money are they saving into a savings account on a monthly basis? And that question is a loaded question. So if they say, yeah, I'm putting $200 into a savings account, then the follow-up question is how long? I've been doing it for 4 years. Okay, so then you do the math. $200, savings account, 12 months a year, 4 years. So now I know they should have, is that right? It's all right. 200 times 12 times 4. Yeah, that's right. If they're real, they should be putting there should be $9,600 in their savings account right now. So then I have to go back and ask the question, okay, how much money is in your savings account? Oh, about $4,000. They're not saving $200 a month because they're spending some of it. So I have to take that $4,000 off this $9,600 because they're not using it like a savings account. They're using it like a bank account and cycling through the dollars there too. But $4,000 is the level in there. So I can use $4,000 as 4,000 divided by 9,600 times 200. I can use that number as part of my funding strategy. And then here's the biggest one. And every time I do this, especially when people are over 55 years old, every time I do this, they always say the wrong thing. Derek, do you have a 401k? Yes.
Yes, I have a 401k.
Is your company matching your 401k? Yes.
Yes.
How much are they matching you? 3%.
3%.
And how much are you putting in, Derek?
I put in about 10%.
There you go. So that's 7% overfunding. Why in the world would I put more money into a 401k that I know I'm going to be paying more tax on later when I pull it out? Why would I do that? There's no logical reason to do it. So from a financial planner perspective, always take the free money. If they're going to give you 3%, put in 3%. They're going to give you 5%, put in 5%. Okay. But there's the biggest place that I find where people are overspending money. So you've got savings, you got 401, you got overpayment on debt. Another good one, life insurance. Remember, what we're doing here is life insurance, right? And I'm not going to throw any one carrier under the bus, but let's say I've got a standard 30-year term program that I took out 10 years ago that I know I'm going to outlive, and I know I'm spending money for it. Does it make any sense to continue paying for it? Yes, if I don't have any other coverage. If I'm getting other coverage that is permanent, it's going to have cash growth, where I'm not wasting the money, absolutely it makes sense. So if that policy that I'm paying is $150 a month, then I've got my little notepad here, and I'm making my numbers: $150 life insurance, $2,200 savings account, 7% overfunding, IRA, right? So I'm just making the numbers, and that's where I'm going to base this. And then the final place is the stuff they don't tell you. Everybody, especially when you're talking to them, nobody's going to tell you 100% the truth. They're not, and they shouldn't. There's no reason for any of us to know everybody's finances. It's not necessary. When you get to that level of engagement with a client where they do really trust you, then maybe you'll get it. But that's not going to happen on your first, second, third, fourth, fifth. I mean, it takes me sometimes years to get to the point where I have that level of trust with a client, okay, where they're going to tell me their full finances. I had one just do it the other day. He actually sent me every spreadsheet, every retirement program, every copy of every bank account, every debt on every credit card, the notes on all of his trucks, his houses, his retirement plans, even his plane. He sent me everything. Okay. So I know the full situation for that gentleman, and we're developing a hell of a plan for him. But that's the point. That didn't happen overnight. That guy's been a client of mine for 3.5 years now. Okay. So the last place is that other stuff. What are they not telling you? Yeah, I think cash is king. So I spend, I've got $100 bills stashed all over my house in pretty much every book. Okay, whatever. You get to that level of communication and that level of trust, that level of engagement, then you'll find out that other stuff. So that's kind of the fifth place is where that I find, and it usually doesn't happen that way. Usually I'll get the first four, but I won't get that fifth piece until way into the relationship. And that's why when you structure these programs, you need to be thinking in advance. What's my PUA contribution going to be at my maximum level? That's pretty simple. All you need to do is take a look. Let's go back to this and I'll show you. Back to this illustration. Right? What's my maximum? This family is paying $5,500 a month on debt service before we started the program. So as a bare minimum for this family, the program needs to be able to capture 5,506 times 12, $66,000 a year. So when I'm structuring the plan, I need to make sure that I can capture $66,000 a year PUA, because when they get to the end, in this case, 5.7 years, that's how much money they're putting in the program, $66,000 a year on top of whatever their premium payment was. So there's my minimum. That's why when I structure these programs, it's not uncommon for you to see my programs that are going to have $100,000 a year PUA. Sometimes we're replacing life insurance. If you're going to be using a life insurance replacement, then you need to make sure that the death benefit is going to exceed whatever you're replacing. It's got to be bigger. Okay, because you can't make a case that their life has become less valuable over time, because that is not the case. As we get older, we earn more money. As we earn more money, we have more people in our family. Our children and even our grandchildren start relying on us and the legacy that we're going to create. Life insurance becomes, you should be ever increasing the amount of coverage that you have, because it's not just you, it's your legacy. So if you're using a life insurance replacement, you have to be thinking that piece. Okay. So the premium is $200 a month for a client, but your APV is based on, all right, so David, there, yeah. So APV is based on the amount of whole life premium and the amount of term premium. Okay. So your answer right there at 200, I have no idea. I've structured programs that are incredibly streamlined. When I mean that, I mean that's 94% cash growth. And in that case, let's say I have a $1,000 a month program. If it's 94% cash growth, that means I'm only using 6% of that $1,000 a month as term and whole life, which means my total APV for that $1,000 a month program is only $720. So you can make them that efficient if the people are healthy enough. And I've also had programs where they understand the concept and I get rid of all the fluff. I'm not looking at PUA. I'm not doing anything. Like I think at Symmetry, we teach the 62-38 or the 60-40 or the 65-35 split. I don't do that anymore. All I'm looking at is, okay, what's the focus? What's the goal? Where are we trying to go with this? How much money are we trying to save? When are we trying to get there? I'll look at all those metrics, and then I'm going to streamline the policy. So I have a client that we've identified $1,800 a month that he's overspending. Okay, I did my initial illustrations at $1,800 a month on a standard 60-40 split. And now that it's ready to issue, I've completely eliminated that initial illustration. And now we're down to a $410 a month policy where $10 is going into PUA. So it's $400 on term and whole life. That is not a 60-40 split. That is a streamlined policy. It's closer to 75-25. Okay, so what you do is based on the client and your client's level of understanding. This is another key thing. I do that because I understand the programs, and I certainly explain that to the program, to the client. If you do not give the client a document that says, this is why we're doing it, this is how much you're putting in, this is, they're going to have the illustration, they're going to sign the illustration, but they're not going to remember that. So put it in bold letters and give them a sheet of paper. Yes, your minimum premium is $410 a month. However, the program and your debt elimination strategy was built on $1,800 a month. Once the program starts, you must start spending $1,800 a month if you want to be on that schedule. So you have to have that conversation and put it in writing. Okay. The putting it in writing part will save you, because I just had that conversation with a client 2 days ago. She didn't remember what we did. Her husband didn't remember what we did. They're very upset now. We're having a conversation tomorrow. It is what it is. I have that document that I sent to them, but I don't think that they kept it or read it or looked at it. But I'll be showing them again and say, this is exactly why we did this. This is what I told you. This is why this is not working the way that we said it was going to work. That's because you're not funding it the way that you said you wanted to. We can fix it. We can pull it, and we've got options, but this is where you are, and this is why you're where you are. So having that document is gonna, I call it a CYA mechanism, you know. So I'm not going to get sued. I'm not going to do anything that's going to hurt any of my clients. And if they want to come after me, I'm going to have all the documentation that supports what I said to them and why I said to them. So if you're going to be doing this, and you're doing a lot of them, please make that documentation, send it to them, create an email trail so that it goes out via email. So you can say, yeah, I emailed this to you on the 5th of October at 2:18 p.m. 2019. And then make sure you keep a digital copy. Make sure you keep paper file. Yes, paper files. Your computer gets hacked, you lose all your data, you're screwed. All right. Folks, this is we got a little bit more time left. Derek, let's talk to Derek for a few minutes. So you're the golden boy here today. What do you
I don't know that I'm the pupil today. That's what I am.
What do you got? What do you got to add to this conversation, Derek? Something you've seen, maybe one of your favorite clients or case study or whatever, anything, or maybe something different that you do that I don't do, or just something to help the folks that are out there?
No, I think that, you know, when I'm looking at people's income, I'm looking at discretionary income. I'm not necessarily looking for overpayments. I'm looking to find out, like you said, what they're looking to do. And when I'm looking at just trying to get to a discovery phase of what's going on, you had mentioned earlier, people lie. Did you watch House when that was on?
Love House.
Okay, there you go. Yeah. So House MD, but basically, yeah, I'll start going through it. So, you know, what do you already have in place? All right, what kind of assets do you have in place? 401ks, you know, 503bs, IRAs. Just unpack that for me a little bit. What is your family already going to benefit from when you pass? So I know what I don't have to, you know, duplicate. And then I get into there and I start asking, all right, so, you know, what does it take to run your house? What's your monthly run rate? And oh, by the way, of all that you're paying through that month, what has an interest rate attached to it? Okay, are you making any overpayments to that? All right, and so we go through that. Then I go into income. I go, so what, you know, what's your annual income look like? And then I do the math and I, you know, invert it to, you know, 12 months. And I go, all right, so basically what you're telling me here is that you're making $12,000 a month and your monthly expenses are $3,500 a month. All right. And so there's this big gap here. And when I asked you about your assets earlier, you mentioned that you don't have anything in savings. So my first thought is that they're hooked on cocaine, or they have a massive gambling habit.
Vegas.
And I say, so, you know, where's that difference going? Is it going into a savings account or a checking account somewhere? Oh, yeah. I just put it aside in Chase, and I didn't mention that. I didn't think it was important before. They always forget their, you know, what they have in their bank. I'm like, oh, okay. So you're telling me that you've got all this money going every month into a checking account which is earning you pretty much nothing. That's what you're telling me? At that point, they're just, it's not, I'm not trying to do a gotcha. It's just all the oh, I'm trying to leave you at arm's length. I'm not going to open up and share everything with you. They're like, all right, so this guy is going to actually ask me questions. And that's when I start going, oh, okay. So you're making nothing on the money that you're earning. Okay. Let's see how we can fix that for you. And it really expedites that process of getting them to open up to me.
So the question would be, do you mind if I earn you 4% per year on that money and still allow 100% liquidity? Would you be okay with that?
Exactly. Exactly.
Yeah, so you NEPQ'd it. So for those of you who haven't done the NEPQ training, that's exactly what Derek just did, which is exactly what you should do. George, you got a comment? Nope. Okay.
Yeah. Legally, I can't overinsure you. Ethically, I don't want to underinsure you.
Right. Right. So, and then there's guidelines out there for how much insurance people should have, by the way. Transamerica's got a great explanation of that. And if you can download, it's just a one-page document. But basically, you're looking at really, especially as they get older, you're looking at 15 times earnings. Whatever they make per year, that's a nice magic number that you can use. Is like, you know what? The National Association of Insurance Providers or Insurance Carriers, NAIC, recommends that you have somewhere around 15 times your earnings. How much did you make last year? 110. All right, so we're looking at really about 1.6 million in coverage. How much do you have? 100. So you're a little shy. So let's see what we can do to get you there also. Okay. So yeah, we're going to create this environment for you where you're going to earn 4%, maybe 3%, maybe 8%. You'll have 100% access to all your money. We're going to get you all the life insurance and create that legacy for your family. And you'll never need another program. Does that sound good? Okay, great. All right. Anybody have any other questions? Derek, you got any other comments? Come on, buddy.
No, man. I mean, it's been a while since I've seen your presentation, so I was sitting here taking notes, and it's funny how much of through sheer osmosis, a lot of what you're saying is coming out of my mouth when I talk to my clients. So I'm grateful for that.
Right, man. Well, that's what we do here. I mean, half the stuff I've got, I stole, right? I mean, I've done the math on a lot of it just to make sure that, okay, this is what, so not that I want to advertise for anybody that's outside of Symmetry, because one of the people I did get some of the stuff is not part of Symmetry. I went and checked his math, and the stuff that he said that was mathematically incorrect, I don't say, but all the stuff that was mathematically correct, it's in my presentation. So do the math, make sure you can prove it to yourself, right? All right.
And how long have you done this, Scott? How many years now?
My 5th year was September the 18th. I had my 5th year anniversary here.
And how many people have you helped with this program?
So I do about 400 presentations a year. And last year I closed 220. So it's probably close to somewhere between 800 and 1,000 placed programs.
It's amazing, man.
So it is what it is. I love them. So, okay, I see a lot of heads nodding up. Anybody got any questions for Derek or me? Oh, Mr. Kimsey. Thank you again, sir, for being on the call with me yesterday. It was a blast. I had a good time with you.
It was good times. Thank you for inviting me, Scott.
Yeah, man.
Great call today. Thank you, Derek. Thank you, Scott.
No questions, man? Come on. You got the Derek Fitzgerald right here. He's an open book.
So I have written about, let's see, if I open up my my tracker, I would say that I have written about 133,000 in AP. And what gets me is that The people who are basically bringing those people to me, these families that I'm able to help, I've been able to give back, $53,000 to those agents. That's huge. The impact that we're having on these people's lives is huge. Us as agents, being able to help these people, and I've always been looking for that intersection of being able to give back at the same time as I'm able to make all my bill payments. And this has been that great intersection for me. I get the end of my conversations with my clients and they get emotional.
Yep.
And I don't know how often this happens for you, man, but when you get to the end of a conversation and the tears are flowing and they're realizing just what they're capable of doing now for their family.
Yep.
And provide for their families in ways that they never thought they would ever be able to do. Or when you get those people who I had the client today who said, Derek, I just got laid off. My husband just got laid off. We want to make sure that we're not eating cat food if we live to be 80. I mean, it's just like, I came to this business never thinking that I would ever be in this business, but I got to tell you, it's almost like, you unbutton the shirt and there's a big red S underneath, because that's kind of how I feel when I come in and help out. It's awesome, guys. And
So how much good have you done? And I think you and I have had these conversations. It's not about the money. The money's irrelevant for us, right? The money comes, right? So you don't need to chase the money. So as long as you, and that's why for me, and you're getting there too, because I know you're starting to use a different carrier than you have been, right? So now,
this is true,
right? So now, where this goes, I don't have a problem doing that 94% efficient program, where I'm only what my normal commission would have been based on 60% of the premium. Now it's only based on 6%. I don't have a problem doing that. I don't care. And
exactly.
It's once you get to that point and you're doing these, the volume that we do with these things, the not caring part means that you are caring about something and you're caring about the right thing, which is them, your client. And once you get to that point when it's all about the client, then everybody wins.
Yep.
If you're going to win, the agent, if he was a reset, the reset agent wins, the client wins, everybody wins. And then all of a sudden, you got, like I did one 2 days ago, and this young man has referred me to 4 other people. I actually went over his house this morning. He's referred me to 4 other people at the Newport News Naval Shipyard that he wants me to go write these programs for. They're all within 5 years of retiring, that all have 401ks. So, we're going to do some 90, 85% efficient programs for DFL, and then we're going to roll some 401ks. It all comes out in the wash. So good begets good.
Absolutely.
Mr. Matthews, you got any other comments, sir?
No, man, you're right. When you're doing the right thing, right there, you're doing the right thing for them, for their short term and their long term, right? And so that they can get out of debt and they can increase their wealth, and you're basically just deferring income, right? When you do those high efficient things, the residuals, that come through those PUAs and you do 200 of these a year, you're talking, these people stick with these plans. We're talking a tremendous amount of passive income coming in from the work you did one time and help these families, not to mention the referrals you get from them.
Oh yeah. So to put that in perspective, so on those like 80% efficient programs where you're essentially giving away at least half your upfront commission, which is okay. What you're actually doing also is you're doubling your back end commission. And so while I may not make $1,500 on the upfront commission, I only make $750. But what I actually did was increase my rear end commission by $500 a year, every year.
Yeah.
For the next 20 years. So
And you know what? The reality is you're betting on the client.
yeah,
You're betting on the client, right? That they're going to stick with the plan, right? And because you're doing the right thing, the energy and the vibration and the acceptance of that, you know, because they don't know that you're foregoing instant, you know, your upfront commission,
right.
you know.
Yep.
So yeah.
Well, thank you, George. If nobody else has any other questions, let's see. Hold on, I gotta check chat. Is there anything in chat we didn't answer? David, did we answer your question well enough, Mr. Umana?
I think you did. I had an original question regarding the using the DFL as a the bank of the DFL policy as a pass-through to pay your monthly car loan. It's a very interesting concept, or did I misunderstand that part?
So I just use the car as an example of a debt. The debt, what the widget is irrelevant. All I'm saying is, you know, if you're making, so please don't get confused. A standard DFL program, which is for debt elimination, versus an infinite bank program, which is used for cash flow. They're structured differently, and you have to fund them differently. Okay. So you can't use it like you can't use it to make a car payment. You shouldn't. You should use it to pay the car off. Now, if that happens, that let's say you have a $20,000 car, and every year you're going to build your bank up to $5,000 of disposable cash flow within the bank. That doesn't mean you can't take a $5,000 loan and throw it at that car and pay, you know, $5,000 of payments in one shot. That you certainly can do. That's chunking. Okay. But using it to say, okay, I'm going to take my car payment is $500 a month. I'm going to take $550 a month loan from my bank to do the car payment. That's a cash flow process. And we didn't teach that here today. There's a different process. Okay. And there's a different math involved in that. So don't get them confused. All
Okay.
right. All right.
And the other question was, I do have a client that has set up a DFL for, but the carrier came back that they got table rated 3. So of
Perfect.
course now
Love it.
changes everything. So what do I do now?
So table 3 is good. So that's the interesting thing about how these DFL programs work. They work inversely the way that you would think them. So if you got somebody who's standard, then they're going to show up at the regular illustration that you do. At table 3, and this is where it goes into the tax code. At table 3, that means you're getting less life insurance. Okay. You're getting less life insurance. What it really means is you're paying more for the life insurance component. And the way the tax code reads, to make cash growth, the amount of cash growth you can get is based on how much money you're spending for life insurance. It's not really based on the amount of coverage that you have. So someone who's a table 3, their program is going to have, you can make it more efficient than someone who's standard actually. Okay. The one caveat to that is the PUA is life insurance. So therefore, even though you're able to spend more money towards cash growth, the amount of coverage you get is lessened. Okay. So it's a trade-off, but that was, and I have a meeting with a client that I discovered that 4 years ago. I have a meeting with her on Monday. That's where she got tabled to table 4. And because she got tabled to table 4 with the way we were funding it, now all of a sudden her private bank, which was only going to have $15,000 a year able to go into it because she got table 4, her private bank can now be $75,000 a year. So all we did was reduce the size of the bank, decrease her premium, so the program got cheaper for her. So you have to be able to play within the illustration guidelines, but that's interesting. Table 3 is not a bad thing with DFL programs. Okay, not at all. Table 4, actually, you can now. I'm not sure about Foresters or Lafayette, but I know with Mutual Trust, you can write these programs up to table 6 now, and they'll still be viable.
Okay. Yeah,
Scott,
it was.
I apologize, just interrupting. I do have to go help a family. Thank you so much for having me. It was great. Just sitting here and sitting at the footsteps of the master. So I appreciate it.
Shut up.
All right. Take care, everybody.
Thanks, Derek. Thanks for being here, buddy. Appreciate you.
All right. Bye-bye.
All right. Where'd you go? David? Did we answer your question?
Yes, no, that really did help. I was getting worried a little bit, but now I feel much better.
Yeah. So you have to go do a new illustration. Okay. And you'll have to tweak the numbers, but yeah, it'll still work. Definitely. Tammy. I saw Tammy had a question. Tammy, did we answer your question?
Yes.
Okay. All right, everybody. Thanks for hanging out with me on a Thursday night. Hopefully you got something out of this. Go out and help some families. And if you are looking at this for you, get with whoever invited you here and get one of these programs done for yourself. They're wonderful. Bye, everybody.
Thank you, Scott.
Thanks, guys.